this is our third annual event, and the purpose is a lot of the reports and conferences that you go to are more focused on the bigger markets like Dallas, Austin, Houston. The bigger markets. We're going to talk. There's a lot of opportunities in these smaller markets, and that's what we're here to bring info on that. Each of you have your own copy of the 2021 State of the Industry books on your desk or on the table. So feel free to jot notes down. We're going to have a Q&A session at the end. So feel free to ask questions if come across anything. We're going to talk about fundamentals, what's driving the multifamily markets. We'll talk about rent growth and occupancy, and we have a underwriting project that I think a lot of you will find helpful that our research team's been working on the last couple of years. And then we're going to talk about some sales, new construction activity, and then finally we'll sum it up. Carl's will come up here and tell you about financing in this market now and kind of what we see moving forward in 2022. We promise we're going to have you out here about 3 o'clock. Just kidding. 30 minutes, we'll be done.
Okay, so Greg mentioned we do cover West and Central Texas, primarily secondary and tertiary markets. If you look here, this is a market map of a lot of this is taken directly from our website, which is gogettersmultifamily.com. You'll find it in the book in front of you if you have trouble. But essentially, any of the information you need, market demographics, rent growth, population growth, historical data, really anything you're looking for, you're going to find it on that website. And so it'll be a key resource for you, especially the quiz at the end. You'll have a lot of the answers there. So just take it. So right now, Midland, Odessa, that's the highlight of today. When we did this conference back in Lubbock, we obviously focused on Lubbock a little bit. The cool thing about Midland, Odessa is it's all of you in here, I imagine, are somewhat familiar, being that you're here. But just in general, some of the stats that we throw out, people looking to come outside of Midland, Odessa, from Dallas or California or wherever the money's coming from at any given time. One thing that they should know, and it really helps you guys out, is basically 50% of all the oil output in Texas comes from the Permian Basin, right here in Midland, Odessa, surrounding area. And that accounts for almost 20% of the oil output of the entire country. Right now, we checked just a couple of days ago, the rig count for oil rigs here in the U.S., almost 50%. It's like 48% right now. It's varied between 51% and 48% the last few months are right here in the Permian Basin. And so, when people ask what's driving Midland, Odessa, even though it's a volatile market, there's a lot of change fairly frequently. Jobs is what grows. And Greg's going to talk here in a minute about job growth and things like that. Just some of the highlights that we've recently learned about and things coming online. There's a facility out in Penwell, just south of here, about 20 minutes. It's going to be a $7 billion facility built by Naceros. I'm saying that right. I'm not a scientist, I just sell real estate, but it's a gas to liquid plant. They're going to be making it a little bit more efficient, affordable, and that's going to be a 7-year project, 2,000-3,000 jobs, construction jobs, with about 500 permanent jobs at the end for the next better part of the decade. So there's still a ton going on out here, no matter if the market's up or down.
All right, so obviously the rental market, which you're all in, is driven by oil. To get a better handle on, why is the occupancy and rent fluctuate a lot? There's several factors, and I think the overall thing is oil prices. They're going to lead to rig counts. But you can see when it dropped in 2015 from 93 to 48 a barrel, then the rig count dropped from 536 to 217. And then also this latest drop, 405 to 175. Those is driven by oil prices and rig counts. And then as a result of that, the rig counts are what drives the jobs, and people moving in and out is what drives occupancy. So it's kind of and then when you couple that along with new construction, in the last, in 2020, there's over 1,750 units that were brought to market. So 2020, when COVID happened, when the prices dropped in oil, that's when you've seen 75% market occupancy that hung around for a while. Luckily, it's been creating a lot more jobs, and the market occupancy of the last report from ALN was at 83%. So it's definitely improving, and that's definitely a positive sign.
Yeah, so this is this visual here. This is really just more of a summary of some of the markets that we're covering. And these are the 8 major secondary and tertiary markets that we're focused on. So you can see how Midland, Odessa compares, out of all the Texas secondary markets. It's actually one of the markets towards the top with over 32,000 units. at any given time, our team and our researchers, we're surveying 3,500 properties and over 300,000 units. And so when people talk about where's multifamily, what's going on in any of these markets, and they talk about Dallas, or Houston, or Austin, I mean, there's over 250,000 units between some of these smaller towns that people forget about, and it's really what's driving Texas.
All right, so now we've given you a quick overview of the markets that we're in and seen some fundamentals. We're going to talk about job growth and what happened during COVID 2020. Fortunately for Midland and Odessa, the thing that you're best at is the one thing that drives rental demand the most. That's creating jobs. You'll see on here how Midland, as good as Texas is about creating jobs, Midland's almost twice as good. So this is a 15-year average job growth for Midland. United States, negative 0.2%. So all the markets that we're in, other than one, it is outperforming the United States, and Midland is the best. Definitely out of all the markets that we're in, but 15% or 15 years, 2.3% a year is huge.
So a few years ago, before the disease, we were talking about what happened in 2009. We were talking about how long it took to come back from the recession. Some markets made it. There's some markets, maybe like Wichita Falls, that weren't quite there yet. So this is really a visual of what happened during COVID. A lot of people compared to a similar event. And I mean, everybody's down. This is fairly obvious. It was on the news. You couldn't walk outside and not talk about it. Midland, still doing better than the United States at this point. But if Greg, if you go to the next slide. So this is talking about time to recover from COVID. And you might be curious to see that you're not quite there yet. However, we're only about 1,200 jobs away in Midland, Odessa from being completely recovered to January 2020 numbers before, pre-pandemic, essentially. And so there's quite a few markets that aren't back yet. Midland, Odessa we're talking 7.3% most volatile market that we have is 1,200 jobs away. And that facility in Penwell is going to bring 3,000 construction jobs and 450 permanent jobs within the next, it's starting now, 2,600 acre campus in the next 7 years. And this is supposedly the most volatile market. And we're, a big company away from having totally back to normal.
All right, so now we've covered the fundamentals. We're going to go over what rents are versus cost of ownership. And we're going to talk about rent growth and occupancy in these different markets. And we're also going to talk about the difference between market rate rents and affordable rate rents. So anyone that's qualified to buy a home or qualified for a loan can either choose to rent or buy. And according to the American Community Survey from 2005 to 2017, home ownership among all age groups declined. One of the things driving this is price appreciation. And one of our friends here in Midland, his name is Bill Lanier. He and his family have been selling real estate in Midland for years and years. And in Midland alone, he puts out these market stats, and the average price in 2016 was $275,000. The average home price in 2021 was $356,000. So that's an increase of 29% home appreciation, while wage growth during the same time was only at 13%. Now you'll notice, some of these markets are broken down. Hill Country has the smallest gap, and what that means is, if somebody's qualified to buy, it's almost as easy for them to buy that home versus stay in a rental. Notice that 7 of these markets have more than $100 difference, and then Midland's got a $306 difference between what it costs to rent and what it costs to own. So what that means is on these apartments, you're going to have a lot less rental turnover due to tenants buying a home than some of these other markets. Yeah,
so this is the big stat from last year. A lot of people, we were talking at our table a little bit about rent growth. Obviously in Midland last year is flat. This is not unusual. But one of the things to keep in mind is, again, being one of the more volatile markets, if you look across any of these secondary, tertiary markets, the ones that traditionally people were concerned about, what's the stress test during a pandemic or during a recession, they've got the highest market occupancies that they've ever had. All of them basically above 90%, except for the most volatile one. And you have rent growth in Hill Country, 18.5% at 96.8% market occupancy. So if you're down in the Hill Country or somewhere outside, maybe New Braunfels, you're completely full and you're able to raise your rents almost 20%. And this completely changes the landscape of how affordable multifamily is, which is owning a home. And if you look at any of these other markets, traditionally in Lubbock or maybe Amarillo, you were underwriting 1 or 2% rent growth every year, and now this past year it's 5%, 8%, and that's a totally different property. If you increase your bottom line by 8%, that'd be great. Most people don't have a salary inclusive of that every year at their particular job. It's wonderful.
All right, so demand for affordable housing is probably the biggest important housing issue across the United States and has been for years. We're very fortunate to live in markets that are affordable. On average, in these markets, people spend between 16 to 23% of their income on rent. If you compare this to other markets, like your coastal cities, your New Yorks and LAs, people there are spending between 40 and 45% of their income on rent alone. The majority of the properties that we talk about here are going to be market rate or conventional, which just means that the owner can charge whatever the market bears for the units. On the other hand, you have affordable properties, which could be all your tax credit properties, your project-based Section 8 properties, et cetera. Now, look at the markets with the smallest gap. Amarillo, Wichita Falls, there's only in Wichita Falls, there's a $68 gap between affordable rents and market rents. So the big risk in those markets is if a tax credit developer builds a brand new property down the street from one of your Class C properties, if they qualify, they're probably going to move to the newer, nicer spot pretty easy. Now, the markets with the biggest gap, say Hill Country markets, $393 gap. Some of these markets, if you're making a minimum wage, the annual income is $15,000. Well, in these markets, it takes almost a $47,000 annual salary to afford the market rate apartment there. So you can see in these markets, it's crucial for affordable housing development. So now we're going to talk to you about an exciting project that a research team started on 2 or 3 years ago. You want to take some notes here. This is probably info you're not going to find anywhere else. So it's crucial to depend on accurate data when you're underwriting new properties. Many of you see the National Apartment Association survey of operating income expense every year. And their survey is the average unit size for the market deal is 267 units. And they've got over 2,100 properties that they surveyed. We've looked at these numbers and we found that for the markets and properties that we operate in, they're unreliable. I mean, you can't compare a Class A asset in Seattle to a B or C property in Midland. The numbers just don't match up. So our research department started this project and we underwrote. We've got over 125 properties in this project that we underwrote, and there's about 12,000 units. The average deal size is 98 units. So here's the info that summarizes that. Notice the NAA survey, the net operating income percentage as a gross potential rent is 60.5%. On ours, it's 44.6%. So if you want true economic occupancy levels, payroll levels, what your average water bill is in San Angelo or Midland, we've got the data for you. So we sell these market specific reports for $500 each, or if you want a complimentary copy, we can give one to you if you can exchange some of your property financials with us, and we'll include that info in the following year's reports. So we guarantee confidentiality. We're not going to identify the property on future reports. It's managed for market averages. So now we're going to talk about some sales activity, talk about cap rates, and also some new construction.
So over the course of last year, and these numbers here pertain to the kind of the major 8 markets and maybe some of the surrounding really small markets that we're covering secondary. There were 83 properties and just over 6,500 units on the market right now. Just extremely high. We're just entering the third quarter here. And there's 142 properties, just over almost 14,000 units sold in 2021. It was a lot. It's pretty much a record year for any of these smaller towns. I know in Lubbock, I think we were just more than 29 properties and 2,500 units. That was the best year Lubbock's had, at least the most velocity it's had in a long time, if ever. So, this is a highlight Midland, Odessa. These numbers are as accurate as the data that we have. So, we do our very best. Sometimes the city transaction data is not always up to date, but we're getting there. So there's 4 properties, just over 300 units that sold last year. A lot of you know it's somewhat of a slower year. This was expected. Right now, as of now, there's almost 900 units of 10 properties on the market. So double what sold last year is already for sale right now. Midland, Odessa specifically, picking up huge. And these numbers here, these are any investors in here, all of this, like some of the first questions they always ask. Across the board, the average cap rate we found for sold property out of all the properties we tracked, out of that number, 14,000 units that we were tracking, or 6,500 units that we're tracking, we've got about 20% of those with firm sales price, firm income data, and the average cap rate is 4.8%. This continued to remain fairly low. Greg's going to talk about, and Carl's going to talk about the debt markets here in just a little while, and that helps a lot of why these cap rates are so low. Average price per unit was just north of $60,000 a unit. If you were, Lubbock a few years ago paying $30,000 a unit, those times have changed. Those times are gone. So which has been a huge growth in terms of price per door and average returns.
All right, so other than investor demand, all the tax benefits you get from multifamily investing and just popularity of multifamily investing, interest rates and financing are what drive pricing more than anything. This one side explains a couple of things. One is how to come up with a cap rate in a market that doesn't have a whole lot of sales comps. So say Midland last year, 4 sales, one of those might have been a newer property, one might have been an older, smaller property. So you can't get an average and come up with real numbers. So, and the other thing it tells us is how different people can value the same property differently. All you need to know to get a built-up cap rate is find out, one is what kind of debt can you put on a property? And then the second thing is what your investor return requirements are. So this is just showing different types of loans, different types of ways you can finance a property. And since most investors utilize financing to buy property, it's important to remember that if you're getting a 75% loan, well, 75% of the cap rate is going to be based on the financing you're getting on it. Without leverage, if you bought a property all cash and you wanted an 8% return, you'd have to buy it at an 8 cap. Well, if you put an interest-only loan on the property, you can buy that same property at right under 5 cap and still get your 8% return. So this is an example on a property that generates $1 million net operating income for the year. You could pay $12.5 million for it all cash, or you can pay a little over $20 million for it with an interest-only loan and still get your 8% return. That's a 61% difference in the valuation of the property. So, talking about valuations of the property and talking about how you arrive at your bottom line, the net operating income, as you guys are all aware, is extremely important in where you get those numbers from. So, and the main thing is just being consistent. Is it your trailing 3 income that you've annualized over last year's expenses? Is it, last month's numbers that you just annualized, and that's how you're going to go for the year? But just having a consistent data set of where you're getting your information is extremely important. But the other thing that we always like to highlight is every dollar counts. And it's like a very cliche saying that makes a lot of sense. And then you see it on paper when it comes to these valuations. It's pretty wild. So we're talking about average cap rates in 4s and 5s last year. Well, every dollar at a 4 cap is a $25 difference in valuation, and every dollar at a 5 cap is $20. So $25 per dollar, maybe on $1, not the end of the world. But if you're able to raise your rent, say $25, just across the board, $25, 12 months at a 4 cap, that's a $7,500 per unit increase in your valuation. So a 100-unit property, just by a $25 rent bump over the course of that year, you've increased your value of the property by almost $750,000, almost $1 million. You can't raise rents, maybe it's a flat year, but you have an older property, 30, 40, 50 years old, and you go in there and you cut your expenses. You do maybe a water conservation study that's become increasingly popular in terms of value add. This can save you 35% on your water bill, and that's conservative. And so you save 35% on your water bill. Maybe that's $4,300. In this case, we did it over $174 a year, a unit per year in savings. That's $4,300 increase in your average valuation per unit at the same 4 or 5% cap rate. That's a $500,000 valuation just by spending $300 a unit to make your plumbing more efficient. And so there's like a lot of little things like that. When cap rates are still so compressed, they increase the value exponentially. All right, so now we're going to talk about some of the new construction, what's in the pipeline, and annual absorption.
Yeah, so this is a big ticket item. Well, I know we were talking at our table a little bit about wow, it just seems like there's really construction has never stopped. And so there's a ton going on right now across the board in West Texas. Today we'll just highlight Midland a little bit. 2014, if anybody's here, it was a huge year. There were almost 2,000 units coming to market. was big time. Last year it was almost 1,800 units, and so, or in 2020, excuse me, it was almost 1,800 units. And a lot of these really comes down to the absorption. A lot of these have been planned for 3, 4 years, 2, 3, 5 years. It really doesn't matter. And so this is showing is in last year, it's almost 3,000 units that have been absorbed in Midland, Odessa. And this is considered, it's considered a flat year. This is the last 12 months out of year end 2021. And so when you look at new construction to absorption and you still look at your occupancy rate climbing, there's still just a healthy demand for new construction in the Permian Basin. And this is really just a map of where some of these are. If you guys live and work here, you can see some of these properties. The absorption numbers are always going to be a little bit off if there's a property that maybe is just in the planning phase, hasn't been built up yet. But according to our data, this is where you can see some of these new properties coming up.
All right, so now we're going to talk about outlook for 2021. We'll bring up Carl Pankratz with Blackacre Commercial. He's going to talk to you a little bit about financing in these markets. Carl has been a huge resource for our team. He's been able to help out a lot of our clients and does a top-notch job.
Yeah, he's the money man.
Thank you, guys. Thank you. I've never really gotten applause before, so this is awkward for all of us. So I'll try to press forward here. Who's in the property management side? Show of hands. Who's a vendor, whether it's carpet or plumbing or? So it's odd. It's like right now you see so much news about kind of the interest rates. There's a story on the federal level about are we going to potentially punish banks that have energy exposure? So that's out there kind of looming. I would say this. I would say that there is still a lot of room and a lot of demand, and there's in my opinion, interest rates it's going to really take 200 basis points in order for the market to really feel an impact because there's so much money out there, right? So it's kind of like as we're living our lives and all of us are independent. My dad painted bathtubs, countertops, and sinks. I grew up in the apartment association. I know how it's easy to talk dollars and cents, but like these are lives that are at stake. And so, for some of you, just kind of as you see so much national news as it affects us as the apartment industry, right now there is the demand and interest rates are going to have to climb substantially to really affect the capital market. So, I do want to say that there is that out there. So kind of moving forward, what is out there? So the capital sources, they just talked about a couple of things. Number one is if you want that 80% leverage, really there's two places for it, maybe three. But number one, banks are going to 80% loan to value in Midland, Odessa, right? On a refinance cash out, you might go up to 75, but you are able to get that. We just finished a project in Odessa, 10-year fixed, 3.95% interest rate. And that's a market rate property. So there are instances where you can do that on a full recourse basis. Now, if you're moving to non-recourse basis, a couple options. Number one, bridge loans. So bridge loans are the loans that obviously help you. It's a 3-year interest only. You're going to include CapEx into that. And those loans are running maybe somewhere 400 over or so. So it's a little bit more expensive than maybe other markets. But if you're going to buy, that still gives you a lot of capital to buy. And those markets are still focused on Midland, Odessa, even if it's a little higher in Ford. And agencies, if you're working on an affordable property, so a property that maybe it's capped at 80% AMI or 60% of the 50% of the units at 60% AMI, you are going to be able to get a little better interest rates, as that's one of the hot buttons right now with the government is affordable housing. So you're able to get 80% there on a refinance as well as a purchase. So there are pockets of money available. And kind of circling back to interest rates, I was kind of looking at today, we are a little higher than it has been in a while. We're at 2.76 on the 10-year treasury, right? But as a comparison, I was kind of looking at, kind of where have we been in the past? And in 2018, the 10-year treasury was at 2.54. So what does that tell you? Well, it's a lot of us that were in the business in 2018, people were still buying. So people were buying at a higher 10-year treasury. So people are still going to be buying at a 2.176, right? But, in 2006, the 10-year treasury was at 4.63. So it has been higher and you've still seen activity. So it's kind of to wrap, I just want to say that Obviously HUD is an easy way to go non-recourse, 80%, but it takes 9 months to get closed on a refinance. That's a great tool out here. But banks are still heavily invested. Debt funds are still definitely still interested, and agencies are very interested, especially if you have an affordable property. So if any of you guys want to talk, I'd love to talk to you about how you can refinance or help purchase. But these guys have put together a lot of research, and I know for me, it'd be hard to list a property in Midland if it wasn't with these guys brokering it. So I appreciate you guys, and I hope to meet all of you. Thank you.
Thanks, Carl.
Really appreciate you. All right, talk about the website a little bit.
So we mentioned at the beginning, but GoGettersMultifamily.com. Again, if you're tired of hearing us talk, this is going to have the same information. Tons of resources out there for you. Market occupancies, demographics. If you're curious about maybe how your property is performing compared to the rest of the market, this can be a resource. We call it our market map, but just go to the markets we serve and you'll find it. GoGettersMultifamily.com. It's sort of a one-stop shop.